Gautam Duggad is now joining us, Head of Research Institutional Equities at Motilal Oswal. Gautam, good morning. Thanks for joining us. We've put behind a very strong earnings season, right? Have you upgraded your numbers? By how much? And which sectors do you think would lead the upgrade?
Hi Anuj, good morning. Yes, we have upgraded the numbers once again. This is like an upgrade which has happened 3 times in the last 3 months now. And upgrade is around 5% for FY21 and 3 odd percent for FY22 and 23 each. So now we are at an EPS of 541 rupees for FY21, which will mean a growth of 16% Anuj, for FY21 earnings for Nifty. And this is a far cry from, say, April or June, when we were expecting a decline of around 10%. So from a decline of 10%, now we are likely to end with a 16% earnings growth for FY21. This will be the best in the last 7-8 years. And FY22, of course, looks even stronger. So it's quite intriguing that in a pandemic year, you're ending the year with a 15% earnings growth. And it's led by, virtually every sector. But if I have to point out 3 or 4 sectors, then sectors like auto, consumer durables, metals, and IT. These are the sectors which have seen maximum earnings upgrade. Of course, private banks as well. So these are 4 or 5 sectors which have led the earnings upgrade. Earnings performance has been very broad-based as well. I mean, it's been a big beat and a big upgrade as well. And it's across the board. So it's a pretty ideal quarter in that sense.
Gautam, good morning. Thanks a lot for joining us. Is there any downgrade? What is the upgrade downgrade percentage?
Sure. Lata, so upgrade to downgrade is massively in favor of upgrades. The ratio is 7:2. So for every 2 companies, we have downgraded earnings by more than 5%. We've upgraded by 5% for 7 companies. In our universe, there are 70 companies which have seen upgrades of more than 5%. And just about 19 companies where downgrades are about higher than 5%. And this has been the ratio even for 2QFY21. So clearly, the earnings momentum has spilled over into third quarter of FY21. 2 months back, we were all wondering whether the growth that we have seen in 2QFY21 of 17% in Nifty earnings will sustain or not, because large part of it, people were saying, was led by cost benefits, and therefore it is not sustainable. On the contrary, we have seen third quarter Nifty growth of 22%, which is even better than the last quarter's performance. And this has come versus expectations of about 7 or 8% that our team had for Nifty earnings. So clearly, it's a quarter which has ticked all the right boxes.
Absolutely, Gautam, morning, right? It's sort of the perfect setup, right? The commodity plays started firing up because of global prices moving higher, domestic demand, and I completely take your point. A lot of it was festive season and this whole concept of revenge spending and revenge buying. So therefore, my question that this level of, the demand drive that we've seen, do you think it's sustainable going into Q4 and then onwards into next year?
So yes, cyclicals have driven the earnings clearly, as you mentioned, on commodities. So more than 75% of our incremental earnings in this quarter on a YY basis has come from 4 sectors: autos, metals, cement, and oil and gas. So cyclicals have clearly led from the front, and this is happening after a long time. Otherwise, we have seen defensives, financials, and IT driving the earnings for a large part of the last 5-6 years. As far as sustainability of the earnings go, I think it's a bit tough to predict. But I also want to point out a fact that just pent-up demand cannot drive such a strong volume growth performance. You've seen 35 to 40% volume growth in a lot of the consumer durable/discretionary stocks, Havells, Asian Paint, and there are a lot many, out there who have reported more than 20% volume growth. Even staples have reported 15 to 20%. Some part of it, of course, could be pent up, but just pent-up demand cannot drive 30-40% volume growth. Clearly, we are seeing economic growth recovery happening at a very rapid pace. Vaccination is, continuing. So I think that large part of this growth could be sustainable. Of course, we may not get 30-35% volume growth for companies every quarter, but this could certainly be far better than the volume growth band that we had seen pre-COVID. So if you are growing volumes at 5 to 7% in pre-COVID days for the same companies, it is quite possible that they may see the volume growth band lifting up towards 10 to 12%. And then you also have a support of commodity prices. Inflation was lacking for a long time. And this is the first time that we have seen a 10% top line growth in Nifty X of commodities like oil and gas, which is at a 7 or 8 quarter high in terms of top line growth. So top line growth is also recovering. Volume is recovering, of course, and you have some inflation coming back, which is allowing companies with better pricing power and brand strength to impart pricing hikes in their respective categories. So I think this is sustainable. Just that the percentage growth that you might see in the next 2 or 3 quarters may not be the right way to look at it, because the next 2 quarters you are now entering with a very low base of March 20 and June 20.
Okay.
That being said, on a full year basis, because full year irons out a lot of these quarterly fluctuations. So FY21, if you are seeing a 16% earnings growth, FY22, our expectations is 32% earnings growth. So that takes care of a lot of things on sustainability of demand and whether it is pent up or not.
Okay. So, what explains, by the way, Nestle is now down 4%. And this is one space which, a lot of people are asking. Nestle, Britannia, Lever. They were the stocks that, of course, made so much wealth over the last 3 years. But last 6 months have been quite tough for all these stocks. Gautam, your thoughts?
Of course. Yeah, Anuj. I mean, these are stocks which have created tremendous amount of wealth over the last 15 years. For example, Hindustan Lever has been flat for a year. But last 10 years, CAGR of Hindustan Lever is somewhere around 24%. Similar CAGR for last 3 years also. And that is the case for even Britannia, Pidilite, the likes of Titan Asian Paints. Clearly, the valuations were rich. And now the incremental earnings drivers are changing, Anuj. At the margin, you are seeing cyclicals driving the earnings. I just mentioned about metals, oil and gas. Next year, we are seeing earnings coming back strongly in auto. In fact, cement has done very well throughout the year in FY21. So people who were underweight or not positioned well for some of these cyclicals are at the margin changing their portfolio positioning away from defensives towards some of the cyclicals. Financials remain a very large part of the portfolio. So it's not inconceivable that some of the stocks can have some extended period of time correction. But fact remains that they are the best plays on underlying consumption recovery. It's just that for somebody who has a view of 1 year or less than 1 year, they should not take exposure to the stocks. The stocks are truly meant for long-term investors having more than 3 years of view. They will still make money from here, in my view, because their underlying franchise strength has not diminished. It's just that they had run up a whole lot. And at the margin, the market's earnings drivers are changing in favor of other sectors. So people are, shifting some positions away from this traditional defensives towards some of the high betas and cyclicals.
Okay, Gautam, now I want to confront you with the consensus. We are flashing your line. EPS for the current year, you are expecting Nifty EPS to be 541. Yesterday, Prashant presented the consensus. Bloomberg consensus is 529. So you're 541. That's what, a good 12 rupees. And FY22, the consensus was 704 or 5, which Prashant presented. You are at 720, right? And FY23, the consensus was at 829. You are at 858. Where are you so much higher than the consensus? Which sectors?
So Lata, 12 rupees means 2% on a 529 rupees of base.
All right.
On a 719 rupees of base, 20 rupees of base versus 703, it will be 2%. So higher by 2 to 3%. I can tell you where our estimates are. For consensus, I won't know. As far as our estimates are concerned, we are expecting sharp earnings rebound next year from 3 sectors. One is auto, where we are projecting the auto Nifty companies' auto profits to go back to the previous size of FY18. FY18 auto companies had done a profit of 30,000 odd crores. And that has come down to 15,000 crores in the last 3 years in FY21. FY22, we are projecting it to be 32,000 crores again. Second sector is BFSI, which continues to do very well. They've done well in FY20, FY21. It's just that the pace of acceleration is much higher in BFSI segment in FY22. And the third last sector, which is adding significant delta to the earnings, is metals, which is going back, or rather it is exceeding its previous peak profits of 22,000 crores. And now it is expected to do a profit of 27,000 crores as far as Nifty metal companies are concerned in FY22. And then traditional safe havens like consumer, IT, pharma are expected to deliver their 15 to 17% earnings growth in FY20. But if I have to point out 3 sectors which are driving the earnings for FY22 for our Nifty estimates, then it is auto, BFSI and metals.
Now, Gautam, we've discussed a lot of numbers and earnings projections. Now I'm going to overlay this with price, because at the end of the day, it's all about price, right? Now you tell us, in terms of valuations, is there any pocket where some of these projections are still not adequately reflected? So basically now I'm trying to look for zones, buy zones, where everybody would want to get in.
So Surbhi, this is a problem typically you confront in every bull market. Where market keeps doing well, earnings, at the beginning of the upcycle, you will always find valuations expensive. We've seen this happen in 2004 to 2008 period. When markets kept doing well, earnings kept beating analyst estimates, and we kept finding the valuations expensive. This time around, the same thing is happening, just that the sectors which are driving the markets are very different from the sectors which drove the market in 2004 to 8 bull run. Now, as far as valuations are concerned, I will look at it in two ways. First of all, we are not used to earnings growth of 15-20% for last 8 to 9 years. This has been the best quarter in a decade as far as earnings are concerned. FY22, if we get 30% earnings growth that all of us are penciling in, then that will be the best earnings in the last 14 or 15 years. And markets, once they get a hang that earnings upcycle has begun, then this upcycle can last for 2 or 3 years or even more than 4 years. Given that private investment, which has been down in the dumps for almost 12 years, is seeing signs of some revival, and budget has done a commendable job in pushing for capex and private investment. So the drivers of earnings can incrementally change, as I mentioned at the beginning, from consumption and IT towards financials and some of the cyclicals like metal, cement. Now, metals have rallied, cement have rallied. But to answer your specific questions, there are stocks in those sectors where valuations are still not out of the whack. You've seen consumer valuations, but they traditionally remain very expensive as far as relative valuations are concerned with respect to the market. Financials, I still find a lot of value in large cap private sector banks. And I think financials will turn out to be the sector of the year as far as 2021 is concerned, because the numbers have been very strong. Underlying operating drivers have been very strong as well, and commentary has been upbeat. Plus, asset quality and restructuring has been far, far better than what people were fearing in June or July. So clearly, there are definitely pockets out there where you can still find value. But clearly, in a growth market, seeking for value does not lead.
Gautam, can you share any names? We're almost running out of time. If you could share those names, where prices you feel still have not run out of whack, if possible.
So we like large cap private sector bank, as I said, ICICI, Axis. Within PSU, we have preference for SBI. Then in NBFC, we have Muthoot. In life insurance, we like SBI Life and Max Life. In cyclicals, our preference is very strong for Ultratech, L&T. In metals, we like JSPL, Hindalco. So L&T is there. I mean, a lot of these cyclical stocks, they select themselves. And in consumption, the preference has been more towards discretionaries like Titan, Varun Beverages, Crompton Consumer, and among staples, it has been Hindustan Lever and Pidilite. And lastly, we are still very overweight on IT. We have an overweight of 300 basis point preference for Infosys, SCL Tech, and TCS. So that's how we are navigating in our multi portfolio.
Okay, Gautam, pleasure speaking with you. Thank you very much indeed for joining us and giving us your analysis of the Q3 numbers and leaving us with a lot of optimism as well. Thanks a lot for joining us. I think the best takeaway was that 7 upgrades to 2 downgrades. That's some indication. 16% EPS growth this year and 34%, if I'm not mistaken, is what he said for next year, and the year after as well, something like 20%. So we are back to the double-digit earnings growth, and how. Let's take it now to specific companies. Petronet LNG's numbers, it was a top-down beat for the third quarter. Numbers came in better than what the market expected, but some concerns are there